Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It is Macro Monday time. Just a reminder, we've got CPI this week, Wednesday, and then we've got MLK Day, which is a U.S. holiday, next Monday. So U.S. markets will be closed. I'll be on a Twitter Spaces with Trueflation this week, Wednesday at 9:30 a.m. to discuss alternative data and how great Trueflation's been. If we talk about the usual flows from James Butterfield, and we're going to have a new scale here coming up on these ETF approvals, which are almost certainly going to happen sometime this week, with trading probably starting sometime this week, next week at the latest, I'd imagine. But we're continuing to see inflows based on price today. I wouldn't say it's priced in. I'd say it's getting priced in, but I wouldn't say it's priced in. I think we'll see some pretty interesting price action around the approval, around the launch, and then the window of certainty for me as far as what price is going to do post-launch is pretty wide, because it's really just dependent on the flows and the plumbing of the ETFs. You know, if that breaks down, if there's issues on that end, some unknown, or premiums get too hot or whatever it is, that could certainly slow things down. If the GBTC outflows are massive, which based on prices, they should be massive of the fee, that could slow things down. But we're still seeing inflows. Looks good across the board. Bitcoin seeing massive inflows relative to everything else. ETH seeing inflows, Solana seeing outflows, which makes sense because Solana, again, was up whatever it was up last year, 500%. People taking profit, starting to get into ETH. And I still see people to this day talk about ETH, ETF. Look, that's fine, but you're missing out on this Bitcoin run. You're missing the massive run we're going to have. Just a huge opportunity cost and failure of assessing what's going to run there. I'm not going to tell somebody how to trade their book, but one step before the other here. Let's crawl before we try to run into ETH. And the other question I have for these people is, what do you think the ETH inflows are going to be to those ETFs? High, low, zero? You tell me. Most of this coming from the United States. Here's the updated table of all the fees for all the ETFs. And Grayscale, just massive middle finger to all the holders, to everybody who thought they would bring fees down and actually be competitive. To me, this does two things. This promotes people to leave, discourages people to enter. There were people saying, well, everyone's in so much profit, they're just going to stay and eat the fee. They don't want to pay taxes on that. That's probably some people. If it were me, I'd say enough's enough. I'm out of here, because that's what I'll certainly be doing. I do think the discount completely closes on launch day, inevitably. And that's a great time for most people to get the heck out of Dodge and potentially move into another product or move to cash, whatever you want to do. BlackRock, very competitive. Bitwise, very competitive. And all this is very pro-consumer, very pro-holder, and certainly hurts the issuers because they're not charging that much in fees. And these fees are much lower than retail exchanges. So hopefully we see some fee compression on the retail side as well, specifically Coinbase, which is basically highway robbery with the amount of fees that they charge. I think it's like 1%. If we look at the Bitcoin chart real quick, we do have a bearish divergence multi-month. Based on how divs work, we will continue to build this bearish divergence until either A, we cancel out the divergence, which is possible. It would mean RSI reaches a point above the last peak, which is probably above 80. At that point, we're already screaming. Or we make a continuous higher high in price and do not make a higher high in RSI. If there's anything that can break a bear div, it's going to be the ETF launch. If there's anything that can break past the 48K historical resistance of the 0.618 fib, it's the ETF launch. If there's anything we could actually reach an all-time high pre-halving, it's the ETF launch. Okay, so all that's on the table. It's on the table. It's a speck of dust as far as a possibility reaching an all-time high. I think what's likely to happen is we wick somewhere between 52 and 62. There's some issues with the ETFs as far as premiums. People pull back on the flows initially. I think the outflows of Grayscale at some point probably overcome the inflows within the first week. So I think we see massive volatility in both directions. I think we see a giant pullback regardless of what happens, and we spend the next 4 months repairing the chart. Best case scenario is we shoot to 52 to 62 and then we consolidate in the 50s. Worst case would be straight down to sub 25 right now. I don't think that's a likelihood. Some people are counting on that. I don't think that's the case. But I do think we see some continued move higher, followed by a pretty nasty move lower, potentially around MLK Day, right? If you want to mess with price, do it when the market's closed. If you want to make the market makers and everyone playing around in the ETF land panic, do it around a day when they can't actually touch anything. But we are certainly setting ourselves up for a pullback here, undeniably, just based on RSI. Could it reset? Yes. Is it reset because it hit 50? No, I don't think it did. I think you could read this as just a continuous div. We can even look on the monthly candles. And if we look at all the way back since we've got data, vertical lines here are halving. We don't typically break out on RSI pre-halving. But again, if there's anything that can do that, it's something like this, because ultimately it represents potentially billions of dollars in inflows, a change in sentiment, legal clarity, and all sorts of other fun stuff. So if there's anything that could actually break the rules of the previous cycles, diminishing returns, XYZ around halving, it could be the ETF. I'll believe it when I see it. It's hard to forecast that happening until we actually know what's happening with the flows, but I'm not going to rule that out as far as moving higher and staying higher. This is GBTC. The discount actually got a little bit bigger today. I was wondering if that's because they're just criminal fee level at 1.5. Look, they can do whatever they want, but when you do stuff like that, that just continues to piss people off even more. Maybe we go to 45 on this. Maybe this hits a premium on the approval or launch. Maybe it holds above 0 for a little while, but anything between 45 and 55 is likely plenty for most people, including myself. ETH probably gets a move eventually down the line here. Discount also widening a little bit today. I like 26, but I would much rather catch this in a bigger fashion at 10, right? So the question is, okay, what are people going to do? Are they going to rotate from GBTC to another product in the BTC universe, GBTC to ETH, another product in the Grayscale universe? Are they going to move to cash and just expect to crash and wait, right? This is all on the table, including just sitting here doing nothing, which is what Grayscale's hoping most people do. I assume many people, probably most people, who've been trading this ETF stuff, who have been in the know, will be moving to cash. Some of them moving to other products. And, we'll just see. We'll find out what the net flows are relative to all the other products. It's something to keep in mind. Last year, here's another list of hedge funds. We're talking, billions and billions of dollars. Most hedge funds underperformed everything last year. So keep that in mind when you see massive profits on an altcoin or something in the Bitcoin universe here on the legacy side, and you're like, I want more. I think we can get another 10K above 52, or I think we can get all-time high next week. That's where the greed and euphoria sets in. I personally think it's a little early for all-time high pushing, but we could see it. We definitely could see it. Anyway, on the legacy side, big data point this week is CPI. We had some consumer credit numbers, and of course the doomers are saying it's over, blah, blah, blah. Okay, whatever. I'll talk about that a little bit in a second, but we have some Fed speak, PPI, numbers that aren't going to look great. CPI is going to be rising month over month. Core is probably down month over month. And that's on Thursday, which is also going to be probably ETF decision day. I don't know if we're going to hear about this before then, end of day, beginning of day. I have no idea. So that's just a massive question mark. I know SEC has a meeting on the 11th, I thought, where they might be voting on this. But I don't think there's some hard rule that they need to approve this at any specific time during the day. This is Trueflation, which continues to look pretty good in the grand scheme of things. It says very likely that we will see the January inflation number come down as we near 2%, but not quite below 2%. And the likely outcome based on the data so far of the Fed is going to be, we are likely close enough that we will continue to bring rates down. We hope to see inflation continue to come down to our target. Hopefully it does. This is what they're going to say. And if it doesn't, they're just going to say, okay, well, the new range is between 2.5 and 3.5, or 2.5 and 3, when they realize they can't quite get it down to 2 without absolutely crashing the economy. If we look at the FedNow projections, 2.95 would be CPI. Currently, we're only a week into January, and 3.3 for this past month's CPI, which is the print we're going to see this week. Now, hopefully, because it's being talked about this is being understood and priced in, and the market's not going to flip out when they see a month-over-month rise in CPI. To me, it seems to be pretty well understood that that's going to be the case, and I hope that this isn't enough to hinder anything on the Bitcoin ETF launch. There's been a lot of talk. We'll go to this one first. There's been a lot of talk about shipping, okay? All of a sudden, everyone's a shipping expert again. Everyone's a macro expert. This is what's going to bring inflation back to 10%. I don't think we're quite there. Okay, is this a massive problem? Absolutely. There's been some targeting of cargo ships in this region of the world that's causing transit to go around Africa, which is obviously not ideal. And we're feeling this on the freight index side of things. I can't tell you the number of charts I saw over the past week, zoomed all the way in on this, saying, oh, freight's gone up 60%. Yeah, that's true, but look at where we were, look at where we are. We went back to the mean, or net zero, effectively. There's some event, and yes, it is a problem. It is definitely a problem. It is making things more expensive and making prices more expensive. And I think this gets cleared up relative to issues in Israel and Palestine and the Middle East. That's most likely what this is related to. So if you think that's going to end soon, this probably comes down. If you're like me and think that's going to go on and on and on forever, then that probably stays elevated, and we probably see freight continuing to rise in cost. UK true inflation also holding here, sub 3%. Reverse repo, I talked about this yesterday. We have a little bit left in the kitty here, as they say, a little under 700 billion, and that's set to probably purchase some short-term treasuries that we will be auctioning this week. So you're probably going to see another chunk out of this, somewhere to the tune of another 50 billion, I'd imagine, this week. Many people projecting this to be completely drained by April, hence why you're seeing some Fed governors talk about slowing down the pace of QT, which I'll get to in a second. But this draining of the repo has allowed us to, reverse repo, has allowed us to issue the debt we have kind of without consequences, because that's how we're paying for it. If this is gone and we issue debt at the current pace we're issuing it, yields will probably rise, and that will hurt risk assets. So this has really shielded risk from getting hurt by our treasury and bond issuance. The first step was shifting the issuance to treasuries, allowing the repo to seek out that money, or to seek out those treasuries. Here's meeting probabilities for the FOMC. The next meeting is on the 31st, which is at the end of the month. A lot can happen between now and then. The market is continuing to price in 5 or 6 cuts throughout the year. The Fed has said probably 3, but you also have Fed governors saying we might need to hike again, which, based on the Stanley Cup sales and other nonsense going on in the United States, yeah, keep hiking, right? Like, there are clearly the haves and the have-nots. The haves will always do fine in any environment. They will benefit from monetary expansion, or they will benefit from interests, which they're clearly doing, right? That's a massive stimulus to those holding treasuries. So you can't tell me the upper crust is not doing fine right now, because they're doing fine. This is Lori Logan talking about specifically connecting the dots here between reverse repo and QT, kind of as many people have already done so. I'll leave this in the comments or in the description of the video so you can read it. But she's basically saying we might have to slow it down, which is logical, because you've had this buffer that's running out, and now you're really going to feel the brunt force effects of this without the reverse repo. And Andreas kind of joking around calling it the Logan rule, which I like, QE light, which is, again, that's coming from the reverse repo. But that makes sense. There's a level at which potentially we will not see liquidity fall below, because it would just cause too many problems. And the Fed's already softly recognizing that. Now we start to get into, contentious territory surrounding, is the data real? Is it political? It doesn't matter. The data's fake. And I say this every video, but look, the data's the data. I don't know what to tell you. I could care less from the political side of things. GDP looks good. Jobs look good. Wages look good. It doesn't look like we're going to hit a recession anytime super soon, based on all that information. The Fed's own estimate is 2.5%. Can this get crushed? Can this go lower? Absolutely. But right now, it looks like things are okay. And I looked up this paper. So this is the NBER, which determines recessions in the US. It's backward facing. You've got all the doomers saying we've been in a recession. We already had our recession. Okay, fine. But this is them in 2008 kind of discussing how can we do this with an algorithm and decide what a recession actually is and looks like. And it's an interesting paper to read, but they go through and they say, look, these are the things we're looking for. We're looking for employment, industrial production, income, ISM, PPI, whatever it is, that other stuff that gets released every month. But it's not just GDP. It's not just any one thing. And there was a lot of discussion around this in 2022 when we had two negative GDP prints. And as they say here, they consider a recession a significant decline in the economic activity that is spread across the economy and that lasts more than a few months. It considers the depth, diffusion, and duration of the decline. So keep that in mind for your own adjustment and all the information that's being spit out at you regarding recession. I think we likely see it this year, but I also think it's too early to call it based on current data. And if we look at historical soft versus hard landings, interesting, by the way, the source on this is the World Gold Council. So again, that tells you who's selling you this information or who's presenting this information. But historically, soft landings are very rare, so it's unlikely to happen. For me, it's a natural part of the business cycle. Of course, we have a recession. That's where we're headed anyway, as far as the jobs numbers are concerned. So just another fun data point to watch for in this highly political year. Then we've got the Druckenmiller recession proxy, which is extremely recessionary based on the current data. So depending on what you want to look at and when you want to look at it and what time frame, we may be already there, but ultimately the NBER decides whether or not it's a recession or not, based on a bunch of different data points. And I care even less about that because, how do you position around this? What do we do? Do we move to recession-proof things like gold? That's what the gold bugs want you to do. Is Bitcoin recession-proof? I don't think so, but I guess we're going to find out, won't we? But the rest of the data still looks pretty good. Yes, we have an inverted yield curve. We've talked about that for a long time. Unemployment ticked down a little bit based on the data. This does not look troublesome in the moment. When this uninverts, it'll be a problem. Sure, but we're not there yet. JOLTS job openings, this is data from first week in January now, came down, continues to come down. So that says the job market doesn't have as many job openings as it did before. And you can see, again, from Andreas here, the rate of change pre-post-COVID has come back down pretty significantly, signaling some trouble there. Payroll growth is certainly slowing and has continued to slow. So again, there are warning signs, but what do you do with that, right? Do we just hop into gold? We sell everything? Sell it all, baby. Sell it all. Hop into gold. That's what the gold bugs want you to do, or buy bonds or whatever, whatever people do. I just don't think we're there yet. I think we're getting there. I just don't think we're there yet. Wage growth still looks okay. As far as relative to inflation, it's probably not where people would want it to be, but it looks okay. It doesn't look terrible. Initial jobless claims, near 52-week low, right? This does not look like an economy in a recession. It just doesn't, not to me anyway. Then we've got housing data from Bob Elliott here that says, look, people are just chomping at the bit, waiting to reinitiate housing purchases, especially as rates come down just a little bit. So there's so much demand pent up because of rising mortgage prices. As he says here, there's still positive momentum in this sector. So it's hard to be extremely recessionary. I think there are issues. There are issues all over the place. There are cracks in the system emerging here, like multifamily delinquencies, 90 plus days in foreclosure here. There are issues, surely. The bottom is suffering, undoubtedly, but that is not felt across the economy by the looks of it. One thing we've done with all this debt is sort of pour it into the, quote unquote, Inflation Reduction Act. And a lot of that spending has cropped up in the manufacturing sector, which has certainly helped GDP. Just another reason why it's hard to get a recession at the current moment. Back to housing real quick. If we look at the apartment supply, that's rising too. So I think this is good for everybody if apartment prices come down, specifically, the bottom half of the country who maybe can't afford housing. So I just don't see how any of that is recessionary in the moment. Shifting gears to oil and gas in the United States, we're at an all-time high in production. We are producing more than any other country as the R&D is sort of caught up with what we're able to pull out of the ground and then use as we pull it out of the ground. Not all oil is created equally, depending on where it's sourced from and where it gets refined. You get different products, but we're doing fine. on the oil side of things, SPR is getting refilled. That is factually correct. Is it getting refilled at a quick pace? It is not. It's down 50% from the peak, but it is getting refilled. It is not getting drained any longer. And the real question is, between these two data points, what is the true value of the SPR as far as where should it be, right? This goes back to 2011, the peak of the SPR. And it makes sense that was also the trough in our own ability to pull oil out of the ground. So as many have said, do we need an SPR to be as large as it was based on our own production, which is currently, skyrocketing? On the gas side of things, we're at a multi-year low as far as opening the year for the national gas price average, not below 2021, but we are down significantly over the prior 2 years. If we look around the country, gas prices in the middle of the country have come down significantly, far below $3 now. So we may start to see an average come down below $3 in the United States, and plot this against, the Biden approval rating, along with inflation, along with unemployment. And it is very interesting that falling inflation on a CPI basis seems to have no effect on his approval rating. Falling gas prices seem to have no effect, and neither does unemployment. So to me, that says, as an incumbent, he's kind of cooked. I think it's going to be very hard for him to get reelected if the sort of Main Street economic retail indicators aren't very helpful for him at the moment. That says there's probably a bigger issue, potentially his age. That's a problem for people. BOA has kind of floated this idea that he's going to step down for health reasons, and the Democratic National Committee is going to name a successor effectively. We'll see how real that is as we approach Super Tuesday in the polls here. Something else to watch on oil that I talked about, a couple weeks back at this point, but to me, this looks good enough for a head and shoulders call. Ryan says he thinks it goes higher, but the technicals do not look bullish for oil at all. This would be, multi-year head and shoulders, multi-month head and shoulders. There's all sorts of bearishness on this chart that I would not expect to see higher highs until we are above 75. I think one of the reasons this doesn't break down is because the US is trying to refill the SPR. So if there is a bid there at around 70, that holds it up. But once we reach that level on the SPR that they deem acceptable, then potentially this goes lower. We're pulling so much out of the ground globally, still, even with all the OPEC cuts. So I think it's going to be tough for this, as bullish as everyone is on energy, to see massive price appreciation. On the S&P side of things, we continue to look okay. Things continue to look bullish. We're at an all-time high here soon. And again, another data point correlation to consider. Does Biden not get reelected with the S&P at all-time highs? I mean, he would have to be one of the few incumbents that doesn't get reelected based on that. And that's going to be something very interesting to watch. But this looks okay. Yes, there's a bear div. We had a week of a pullback. You've survived the January bear market, but this looks fine based on trend. I would certainly expect continuation there. Back to Ryan again. He's put together a list of all the negative first weeks in the year. And generally the outcome here is a very muted remainder of the year. So if you want something that would hurt Biden, again, it would be an S&P that doesn't hit all-time highs. Something else, again, to watch that I'm curious is, does the S&P break out relative to Biden stepping down if he does step down? How does the market react to that? Something to think about. Qs also look fine. Had a little pullback. They're overbought based on the weekly cloud. They've got a div, all that stuff, but I'm still just as bullish as I was late last year on that. Gold also is going to move whenever it wants to. Sorry, gold, we're going to steal your thunder again on the upside relative to this ETF. Gold probably does best when we have some sort of recession eventually, but I don't think that's any time in the ultra near term. And then drilling down to some individual equities, some people kind of curious why coin didn't see massive continuation today. And, again, like Solana, it had a 500% year last year. I think coin had like a 350% year. It's going to take some time to get some new bidders back to this market because they rode this up hard last year. Still looks okay on trend, still looks bullish. From a cycle perspective, I think this does hit all-time highs. I think this does go higher, but that's going to take some time and will be relative to ETF flows. The miners collectively have also pulled back a lot. I think they still look okay. You can see WGMI here, the crazy volume we saw, the crazy RSI spike on the daily. Trend still looks fine. For the miners, you're going to have to watch the fees specifically for the year. It's also important that Bitcoin price continues to appreciate so that post-halving, they don't get absolutely demolished. I think we continue to see M&A. I think the mining in the US continues to consolidate, and that should be bullish for the bigger miners as they continue to get market share. So this chart looks okay going into halving. There's a bit of a yin and yang here because how much of this will be Bitcoin price beta and how much of this price appreciation FOMO will diminish when we have a low fee ETF, much like MSTR, which is down on the day. Yes, Sailor is selling. I get it. Yes, this was overbought, but very odd to see it down on the day as we get closer to ETFs. I think on balance, most people would rather buy an ETF with a fee than have to deal or think about being involved with MSTR or Michael Saylor. This chart still looks okay. Trend still looks fine, but that beta amplification we had seen previously may start to diminish once the ETF has arrived. Then lastly, I just want to shout out the real macro people at Double Line. Watch this video. I watched it twice. I'm probably going to watch it again. Just really, really great points, charts, easy to understand. I'll leave this in the description of the video. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.